Hi, everyone. I'm joined today by Aaron Krawitz of Bravo Capital, and we are going to discuss the current state of the lending environment. But thanks for joining me today, Aaron. I just want to start off by asking, why'd you start Bravo, and also how does Bravo kind of separate itself from the pack?
No, definitely, Ben. Great to join you. And Bravo has three different lending divisions. We have a bridge lender, we have a direct HUD lender, and we have an affiliate mezzanine lender. And I think that reliability and creativity have been our touchstones. We always, strive to do what we say, to be there on time, and to provide flexible solutions. So on the HUD front, in terms of why Bravo, what our differentiator is, I would say, it's really our underwriting expertise, being able to pre-screen, kind of give people outcomes with high certainty. With Bridge, we're able to move much more rapidly, typically 30 to 60 day closing. It's a higher leverage product. And, with our mezzanine affiliate, we're able to essentially layer on top of the capital stack if somebody has a regional bank lender or life co, that they'd prefer to use for bridge, and that's lower leverage, we could get them higher leverage. So with those three tools, I don't know many others in the market that could provide that.
Great. And what's Bravo's history, if you don't mind explaining that?
Yeah, no, of course. So there was a 25-year-old HUD lender out of Arkansas called Lay Commercial Mortgage, founded and owned by Lyndall Lay, who is a phenomenal person. And later in life, he decided to sell the company to me. So on April 30th, 21, I acquired the company and simultaneously renamed it as Bravo Capital.
Right. And smooth sailing ever since?
Yeah, there's definitely been some interest rate volatility from 21 to 23, but welcome the challenge. And I think that the strategy always changes, when interest rate environment changes for a lender.
Mhm.
Uh, so we've seen in the beginning of our history, since acquisition, there were more refinances. Now we're seeing more ground up development, more acquisition finance, and the bridge and the mezz products are in higher demand.
So let's stick with bridge for a second. What kind of terms can borrowers expect for bridge loans these days?
Yeah, I'd say market for healthcare, which of course is our focus, is SOFR plus 500 or so, 75% or so on the LTV. Um, Usually some level of recourse,
Mhm.
whether it's full recourse or a burn down, might depend on the property. Um, and at least with our debt fund, we're usually looking at turnarounds. So we're not looking as much about day one DSCR, but we're trying to buy into the business plan of our sponsor over the long term.
And some listeners may be wondering if there are non-recourse options out there. Are there?
Yeah, I'd say the more you go into non-recourse and the more you go into lower rates, the more it might be a bridge that's coming from a bank or a non-debt fund source. But we see some of those transactions too. And I'd say while some level of recourse, higher leverage turnaround is more our profile, we can be thoughtful. Um, you know, we have been thoughtful, I'd say, and we have done some non-recourse loans too. But that's atypical for our debt fund.
Mhm. Got it. And then this next question, your response could probably last an hour, but for time purposes, we'll try to keep it shorter. But how do you see the terms that borrowers can expect for bridge loans changing, let's say, in the next 3 months and then a year from now?
The main term that's been changing has been, leverage has been going down across the board, and that's been a big concern for borrowers.
Mhm.
And I would say, that the demand for recourse has been stronger, but if not recourse, at least making sure that somebody in the org chart has high liquidity, because just pulling back the curtain behind the scenes in investment committee, it is volatile times, and everybody is asking around the table, if we make this loan and there's a month or so that's a rainy day, does the borrower have the wherewithal where they can make sure that they can make payments for that, month or two, even amidst volatility. So that I think those are key issues that are more prominent now.
Mhm. Yeah, I imagine you're scrutinizing deals probably more than ever right now. But with the SOFR spread, do you expect any change in that in the next year, or kind of stay around 500 basis points?
Yeah. So in my history, just observing the healthcare debt fund market, that was always competitive slash market rate. So whether SOFR was 25 bips or whether it's now in the mid to high fours, it was often SOFR +5. So I don't see that piece changing much, though of course SOFR will change from day to day.
Hmm. Don't we know it?
Yeah.
So who else are active lenders these days? I know that there's been a pullback of a lot of the national banks, but who's still out there?
Yeah. Um, so I'd say a lot of debt funds that were very, very active over the last few years, and especially those that didn't have the foresight to impose rate caps on their floating rate loans and that were priced to perfection. Some of them are pulling back right now. We have the competitive advantage where we're newer. We just recently raised funds, and we have the advantage of seeing the current market climate for all of what it is. So we've been, I'd say, hyperactive. Other groups that we've seen, be active are really banks. There have been some banks that are very well positioned, particularly regional banks. They are lower leverage options, but they're out there and they're lending. And I think that's where the mezz comes in, where if somebody wants the higher leverage, they might pick one of those regional banks over our debt fund, which is perfectly fine. If they're able to get a lower interest rate, and then we'd be happy, to come in side by side with that mezz. But that bank slash mezz solution has been increasingly popular.
Hmm. Got it. And, and then what will it take for the rest of the lenders to kind of open up for new business? Is it SOFR falling below a certain level, or what do you think it'll take?
I think it will take time. Um, we're getting calls every other day being asked to buy large books of bridge loans from other lenders, since it's now known that we've recently raised a lot of capital and have capital to deploy. So while we're not doing that, we prefer fresh originations. I think
Mhm.
that's really the answer to your question, that once some of these other lenders that might be jammed with loans that they're not so comfortable with, they find solutions so that they could either bring in other partners or take some their loans off their books. I don't think it's just a direct correlation to a change in SOFR, but I think there's some restructuring going on, with some of the legacy debt funds in the healthcare space, and I'm sure they'll figure it out, but it's going to take some time.
Mhm. And what types of facilities are having just the toughest time to get financing?
I think it all starts with the sponsor, right? So if there's a sponsor that doesn't have track record in a state, even if they had great track record in a different state, that's hard. Um, you know, if there's a sponsor that doesn't have anybody with liquidity on its balance sheet, um, that's really hard too. Um, we're really sponsor focused. If there are, of course, actual facilities that have, um, you know, a number of significant problems, whether we're talking about special focus or significant tags, harm tags, other tags, that's becoming increasingly problematic.
Mhm.
Um, so those, I'd say, those are just to name a few.
But in many cases, they still have to obtain financing for whatever reason. So what are their options?
Yeah. So we're seeing, from a collateral perspective, people get more creative, right? So either bringing in a partner who has a great balance sheet that could offer recourse, and having that large balance sheet personal guarantee is a great credit mitigant. Sometimes seeing cross collateralization if there are other properties that either don't have a loan or are under leveraged, bringing that into the picture, just to help procure financing for the quote riskier assets. Those are solutions we're seeing.
All right, so it's still an option. So I want to ask about whether you're seeing any problems with those facilities that were acquired or built in 2019. So before the pandemic, probably had lofty ambitions of growing occupancy to 90%, margin to 35%. If you're talking about assisted living or SNFs, less construction, but definitely big plans post PDPM to maximize your reimbursement revenues. And then the pandemic hit, and then staffing issues hit, and many of them did not or could not reach stabilization in time for their anticipated HUD takeout when rates were at least around 3%. So, are you seeing any problems with deals like that right now?
Definitely, and I think Ben, you were spot on as part of the question. You had the answer where the staffing piece is critical. Whether it's for the new construction that came online and started being built in 2019, or even for existing product. I think there's a real bright line today between sponsors who have a comprehensive and thoughtful staffing plan and those who don't, where their staffing costs are just subject to the wind and day by day might vacillate tremendously. So that's a huge distinction. Everybody's talking about staffing, but from a lender's eyes, you could vet pretty quickly who has it figured out and who doesn't.
Mm-hmm. Certainly separate the wheat from the chaff with all the headwinds facing the industry right now. And this my last question is along a similar vein. But we saw a record number of deals in 2022, over 530 that were publicly announced at least, and based on the deals that were privately disclosed to us, it was much higher. But most of those deals were financed with variable rate debt, and then within the SNF market, oftentimes we saw very high leverage and high valuations, usually in the first half of the year, but high valuations continued pretty much throughout the year. So do you foresee any issues in that sector when it comes to refinancing or just the capital costs right now?
Yeah, no, the capital costs for some is crushing right now. Again, especially those who haven't kind of rate capped, it's been very difficult. So I think the press, especially for turnaround facilities, to complete the turnaround or stabilization, to get those facilities usually to HUD as soon as possible, which is the safety blanket, right, where you have kind of fixed rate, long-term, predictable debt. There's a tremendous push for that, but not everybody has been able, to do that in time. So I think we're seeing the beginnings of what might be a continued, volatile 2023 for a lot of sponsors.
That is all but certain, unfortunately. But Aaron, I just want to wrap up with, let's say a listener to this call, it wants to contact you. They have a deal. What are you looking for in terms of a borrower, in terms of a deal right now?
Sure. So I think, we'd categorize something, based on three general metrics, right? We're looking at the sponsor, whether it's the sponsor's track record, whether it's the sponsor's in-state experience, kind of liquidity, professionalism, approach towards staffing in particular. I think that presentation is key. Second, of course, is we're looking at the geography, where the property is located, also the state and the regulatory environment that we'd be dealing with. Mm-hmm. And third, of course, we're looking at the actual facility. And we do site visits. We're looking at the vintage of the facility. And there are many old and outdated facilities that have not been kind of brought up to speed. So that presentation is key. But I think that, as you're saying, a sponsor or borrower who could kind of present all three with a differentiated edge is somebody we'd very much like to talk to.
Sounds great. Well, everyone be sure to reach out if you have something for Aaron. And in the meantime, thanks so much for joining me today, Aaron. Appreciate your insights and looking forward to tracking all of Bravo's success in 2023.
Thank you, Ben. Great speaking.
Thanks,
Take
Aaron.
care.